Today, we break down one of the most consequential global developments in early 2026, the renewed U.S. tariff threats against major European nations over Greenland, and what this means for global trade, markets, and future geopolitics. We'll explain the facts, what's happening now, and what could happen next in simple, exact terms. In January 2026, U.S. President Donald Trump announced a new tariff regime targeting several European countries that have deployed troops or expressed opposition to Trump's interest in Greenland. The key details of the tariff plan are countries targeted: Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, and Finland. Tariff rates: 10% on imports starting February 1st, 2026. 25% on imports starting June 1st, 2026 if there is no agreement on Greenland. These tariffs would apply broadly, not limited to a single product category, and are tied to geopolitical pressure rather than traditional trade disputes. European leaders have condemned the move as coercive and potentially destabilizing for transatlantic relations. The announcement has already moved financial markets. European stock indices, including the FTSE 100, UK, DAX, Germany, and CAC 40, France, fell more than 1% soon after news of the tariffs broke. Gold prices climbed to record levels as investors sought safe haven assets amid geopolitical uncertainty. Analysts have pointed specifically to the threat of a trade war scenario as a driver of volatility and risk sentiment. The potential impact on European industries could be substantial. British Chambers of Commerce estimate that the tariffs could cost the UK economy up to £15 billion by June 2026, driven largely by tariffs on sectors such as automobile manufacturing and whiskey exports. The European Union is preparing retaliatory tariffs on approximately €93 billion worth of US goods should the punitive tariffs go forward. These figures show that even before full implementation, markets are pricing in heightened risk premiums and slower growth prospects. This situation matters for several reasons. 1. Trade disruption. Tariffs of 10 to 25% on broad categories of goods can significantly raise costs for global manufacturers and consumers. Tariffs historically reduce trade volume, raise inflationary pressures, and disrupt supply chains. 2. Geopolitical strain. Targeting allied European nations, many of which are NATO members, over Greenland represents a shift from traditional trade diplomacy to geopolitical coercion. This increases tension not only on economics, but also on security cooperation. 3. Investor risk perceptions. Market reactions, falling equities, and rising gold prices suggest that investors are preparing for a risk-off environment where safe assets outperform risk assets. 4. Broader global growth outlook. Despite these risks, the International Monetary Fund, IMF, recently projected global growth of about 3.3% for 2026, a modest but solid rate, even as trade tensions represent a key downside risk to that forecast. This shows that while economic expansion is expected, geoeconomic confrontations like this one could slow growth or even create recessionary pressures in sensitive sectors. What could happen next? Economists describe 3 potential scenarios. Scenario A: diplomatic de-escalation. If negotiations succeed, tariffs may be rolled back or softened. This would stabilize markets, reduce inflationary pressure on goods, restore confidence in transatlantic cooperation. Diplomatic channels would need to prioritize clear compromise language on Greenland and related security concerns. Scenario B: limited trade escalation. If tariffs remain but retaliation is contained, European markets may remain volatile. Some producers could shift supply chains. Trade volumes might shrink in targeted sectors. This is a moderate stress outcome without full trade war escalation. Scenario C: full trade friction spiral. If the EU imposes its €93 billion retaliatory tariffs and other nations join sanctions or countermeasures, global trade growth could slow sharply. Manufacturing and consumer industries could face higher costs. Global GDP growth forecasts below current 3.3% expectations become possible. In this worst case, markets could enter more prolonged downturns, and geopolitical alliances might realign around economic blocs rather than traditional partnerships. The U.S. Europe tariff dispute over Greenland is one of the most consequential developments in global economics and geopolitics in early 2026. We have covered what is happening, new tariff threats rising from 10% to 25%, immediate market reactions, equities falling, gold rising, why it matters globally, including risks to trade, alliances, and growth, future possibilities, from diplomatic resolution to trade escalation. We will continue to monitor how this develops, especially as February 1st and June 1st tariff milestones approach. If you want accurate, daily global current affairs analyses like this one, subscribe and stay informed.